Bitcoin held firm just above $11,850, showing significant structural support despite total crypto market capitalization declining about 3.6%, driven by lingering profit-taking. Price volatility remained contained between intraday lows near $115,800 and highs above $118,900, reflecting disciplined accumulation activity. Open interest across major exchanges softened, suggesting reduced speculative leverage, while institutional hedging continued. This demonstrates a stabilization zone controlled by long-term stakeholders. Market psychology reflects measured confidence amid cautious positioning. Ethereum maintained strength with prices hovering above $3,840, supported by continued retail and institutional inflows into ETH-based spot ETFs, nearing a 19-day record of inflation. Trading volumes rose by approximately 3%, signaling healthy on-chain activity, even amid market pullbacks. Technical indicators show moderate consolidation beneath recent intraday peaks near $3,880, bolstered by positive DeFi usage trends. Institutional demand remains steady, while volatility persists at controlled levels. Ethereum's structural resilience contrasts with broader altcoin fluctuations. Dogecoin exhibited heavy whale accumulation over the past 24 hours, with a large wallet depositing over 130 million DOGE, likely to strategic trading desks. This snapshot of on-chain data underscores renewed interest in legacy meme tokens as pockets of liquidity remain substantial. Price movement approached resistance near $0.23 as momentum built behind accumulation flows. The divergence between Dogecoin and other altcoins highlights selective capital targeting. Analysts view this as evidence of structural inflows even during wider market wavering. In contrast, smaller altcoins such as Bonk and Shiba Inu declined notably by 5 to 12%, indicating higher volatility and weaker liquidity metrics. Profit-taking triggered sell orders at local resistance zones amid a broader risk-off sentiment across speculative assets. Institutional capital appears retreating from low-liquidity tokens while reinforcing positions in regulated or major-cap assets. Market depth and sentiment diverged significantly between blue-chip assets and fringe tokens. This trend emphasizes investor focus on liquidity and structural integrity.
U.S. equities began strong following blockbuster earnings reports from Microsoft and Meta, which led both companies to surge 4% and 11% respectively, boosting broader tech sector sentiment. The Nasdaq reached intraday record levels before reversing as mixed data surfaced afterward. Despite positive corporate performance, the S&P 500 and Dow closed lower as concerns over rising inflation and rate guidance dampened risk appetite. Healthcare and small-cap sectors lagged, dragging performance. Overall, the market reflects a blend of optimism and caution. Core U.S. inflation, PCE, increased by 0.3%, marking the strongest gain since early in the year and dimming near-term rate cut expectations. Fed Chair reaffirmed a data-dependent approach and signaled uncertainty tied to geopolitical policy. Two board members dissented, advocating earlier rate easing, heightening internal debate. This dynamic added pressure on market pricing for September rate cuts to moderate. Consensus remains that full clarity awaits further consumer and labor data. Global trade tensions resurfaced as the U.S. extended tariffs on South Korean imports while also tightening copper import restrictions, contributing to a historic 22% drop in copper futures. These policy shifts unsettled industrial commodity flows and triggered sector rotations away from materials. Energy and infrastructure equities showed muted response compared to tech and financial counters. Investors rebalanced portfolios to reflect rising policy risk and commodity volatility. Markets now prioritize diversification amid trade unpredictability. Inflation-linked commentary from the White House urged major pharmaceutical firms to reduce drug prices within 60 days, triggering stock weakness in healthcare equities. This directive added pressure on Dow constituents tied to pricing reforms. Investors grew cautious about consumer sectors sensitive to policy intervention. Earnings revisions followed, with volume adjustments across defensive names. Policy risk continues to play a critical role in sector rotation dynamics.
Infosys ADR fell 1.36%, marking its second straight decline during underperforming Indian tech exposure to global headlines. Broader market pressure in global tech indices weighed on shares, despite other global tech peers moving higher. The broader pullback underscores sector sensitivity to macro and geopolitical narratives rather than company-specific metrics. Volume exceeded 15 million shares, reflecting investor positioning shifts. Telecom and consulting stocks of similar profile followed suit. Crypto derivatives activity surged, with over $629 million in liquidations occurring in the past 24 hours, a 45% spike versus prior session amid increased volatility. Market open interest declined marginally to approximately $193 billion, suggesting closing leveraged positions. Combined with the liquidation data, this reflects a recalibration of speculative exposure in crypto. Retail sentiment shifted toward caution, while institutional hedging remained steadfast. Token-specific volatility increased as funding rates tightened. Crypto market cap declined approximately 3.8%, yet progressive gains were seen in coins like Sushi, CHR, REZ, Audio, each rising between 3 and 5%, driven by retail momentum and community activity. Performance among altcoins remained fragmented as many struggled amid broader retracement. Top movers highlight localized rallies independent of macro direction. Market breadth narrowed, with leaders outperforming while speculative segments lagged. Institutional capital preference toward blue-chip assets continues. Solana outperformed many altcoins, with its price rising 1.6% and total market capitalization near $463 billion, reflecting increasing developer and institutional interest in Solana DeFi activity. Daily trading volume hit over $34 billion, showing strong liquidity conditions. Analysts attribute strength to recent protocol upgrades and renewed usage on Solana-based platforms. Despite broader market weakness, Sol retained investor confidence in its network fundamentals. Depth of liquidity supported price resilience.
Tonecoin appreciated nearly 1.5% as its market cap expanded amid elevated volume, demonstrating retail engagement in emerging Layer 1 protocols. The network attracted increased swap activity, which boosted token velocity metrics. Despite modest retracements, investor positioning on TON signaled interest in its ecosystem application growth. Liquidity conditions remained solid, supporting stability during broader altcoin decline. Analysts track TON as part of broader narrative shift toward viable infrastructure tokens. Bitcoin futures and options open interest remained elevated, signaling continued institutional hedging amid sideways price action. Despite price consolidation, open interest held steady above major benchmarks over recent weeks. This structural pattern suggests long-horizon participants are investing via derivatives technology rather than spot tunneling. Premiums in options skew moderate bias toward income strategies rather than directional speculation. Market participants consider BTC more as capital instrument than high volatility asset. Equity futures for U.S. indices recovered modestly in early trading, driven by optimism from strong tech earnings and reduced import tariff uncertainty from Mexico. Nevertheless, sentiment pulled back ahead of key GDP revisions and Fed commentary later in the day. Equity risk premiums tightened as holiday season trading thinned liquidity. Derivative implied volatility across assets remained modest. Institutional positioning indicated cautious re-entry rather than aggressive rotation. Commodities responded unevenly. Gold prices dipped amid lower safe haven flows, while copper supply shocks and tariff pressures created volatility in base metals. Energy prices remained stable as OPEC signals indicated no major redistribution of supply. Agricultural commodity ETFs lagged equity-linked flows.
Investors shifted exposure tactically based on macro inflation signals rather than speculative rotations. Commodity-linked equities showed selective resilience in defensive sectors.
Credit markets remained orderly, corporate bond spreads were largely contained, and auction demand stayed robust even amid inflation uncertainty. Mortgage bonds reflected sensitivity to interest rate levels but maintained structural support from supply shortages in key markets. Demand across credit instruments remained steady. Institutional investors continued to balance yield capture with inflation-adjusted risk units. Liquidity pipelines demonstrate resilience rather than stress. Venture capital continued favoring infrastructure-forward firms in crypto custody and tokenization platforms, while growth funding in speculative DApps slowed. Institutional investors prioritize compliance and enterprise use cases. Capital flows align with maturity of digital asset adoption rather than hype-based speculation. Ecosystem builders focusing on regulatory alignment attract interest. This reflects an evolving narrative of sustainable development rather than speculative cycles. Luxury real estate crypto transactions continue gaining traction as Christie's listings priced in Bitcoin and Ethereum emphasize high-value settlement innovation. Global real estate platforms supporting crypto billing reflect integration of digital wealth with legacy asset ownership. These developments reinforce on-chain asset usage beyond token speculation. Event demand remains selective and high-end. Institutions and ultra-high net worth individuals become key users of advanced settlement infrastructure. In summary, today's market pulse shows resilience across leading crypto and equity segments, stable institutional positioning amid volatility, and selective rotation toward high liquidity, tech-forward assets. Macro drivers including strong tech earnings, inflation signals, and trade policy loom key. Retail sentiment remains bifurcated between speculative retail flows and structured allocation by institutions. Stability above critical levels despite pullbacks reinforces foundational strength in core asset classes. Forward execution will hinge on derivative flows, policy clarity, and corporate earnings catalysts.